Hello. Yes, good afternoon, everybody. I hope you're having a good afternoon. Today is 19th of August 2020. So we are going to start off this webinar today. We're going to look at just some basic tips that somebody should look at whenever they're trading, whenever they're doing the internet trading. So one thing which I want to define now is what is intraday trading. So if you're that person that when you open trades, your trades expire by the end of the day, that is before the close of that business day, then you fall under a category of traders known as the intraday traders. And if you're that person who, when you enter trades, your trade lasts for more than 1 week or some days, then you're known as a position trader. But if when you enter trade, your trade lasts for just some seconds, just some minutes, and you're out, then you are known as a scalper. So today, basically, we're going to look at those group traders, those that they enter trades, and the trade goes maybe some few pips, and then they get out. And also that when they enter trade, they tend to leave the trade for some hours during the day, and then they close the trades just before the end of the day. So you guys who does that fall under the category known as the intraday traders. So basically, we are going to look at some tips that are very useful for those that are doing the intraday trading. That's what we're going to look at. So the first thing, what you want to take account of, what you want to know very well, understand the spreads of various pairs. Understand very well the spread of various pairs. Understand the spread. Understand that during the day, some pairs tend to have a wider spread than others. Some others, the spreads are very low compared with others. So you want to make money when the spreads are very low. So the spreads is this. Somebody might be wondering exactly what I mean by spreads. Just a second, I'll explain that in a moment. Just a second. You can now see my full screen. I will add the ask line, which is here. I have it there. Ask line, let me give it a different appearance. Instead of black, I'll make it a different color. Maybe it should be red. Correct. So just look at my screen now. You will see that I have two lines. If you look at the vertical line, this one 126.45 to 125.35, this is the prices. You look at this line here, the one which has just been added, this is the ask line. 125.8656 is the ask line. The black line which you are seeing is the bid price. The difference between this and this stands for the spread. If you want to know the difference, like if you want to know the spreads, the current spread for this symbol minus this 125.57 minus 125.53, that way you get the correct spread for that given symbol. Is that clear? That is how you know the spreads. If you want to know the spreads correctly, get the difference between this and this one. So you want to trade only when the spreads are very, very low. That's the time that you enter trades. If the spreads are high, that is if they are high during news events, you avoid trading. So intraday traders also, as an intraday trader, you need to find the highest highs and the lowest low for the previous days, because the price tends to reverse from those levels. That's another thing. So assuming this was yesterday, this was 18th of August, this is 19th of August, this is 17th of August, and this is 14th of August. So we start from the beginning of this week, which was 17th of August. This was the high, and this was the low. So temporarily, I'll remove the ask line because I'm having several red lines, so it would be difficult for us to identify the ask line and the lines which you're drawing on our own. On this day, we had this high, we had this low. The next day now, we're having another high here, and also another low. So you want to enter trades when the price approaches the previous day's significant levels, and the most significant levels is not only the opening price and the closing price, but it's the highest and the lowest price for the previous days. So when the price gets to the previous day's highest high, expect a reaction from that point, because that's the same place we reversed from yesterday. It's likely going to be used as a reaction point even today. So if you're a scalper, simply wait for price around those highs. Expect price to reverse upon reaching that level, or if the price successfully breaks beyond that level on a lesser time frame, like in this case, yesterday we had a high here, then the price came down, it pulled back up, but somehow it couldn't break beyond 126.07. So if the price could have gone above this high today, you could have assumed that there's a breakout. If the price had gone above that level, that could be a sign that somehow we are breaking to the upper side. But if the price did not do that, which is in this case, this is what happened, the price could not close above, then this one here became the correct place to look for a sell from, which means even as we're speaking now, we do have a sell position. So I hope this makes sense, that if you're doing intraday trading, understand how the highs and the lows of the previous candle relate to the current candle's movements. So when we have a high, when we have a low, we expect price to come back to this point, and we do expect some reaction when the price reaches this point. If it breaks below, we expect a momentum even further to the lower side. So that is one tip. The next thing is use indicators. Like there's some indicators which are very, very useful, especially if you're looking at them from the divergence convergence point of view, like the stochastic. Let's add it. I have the stochastic. We use the default settings for the stochastic. Just look at it like this. You use the default settings. It is set to default. If it's not default, just click the reset button here and then click OK. So you can see what we have now. So yesterday there was no good example. Let's see what we have. There's any example for the day. Just a second. We're not seeing any good one just yet. This is yesterday. There's nothing good. But today, still nothing. Okay, the previous day, still we had nothing supporting our position. Okay, there's something interesting here. I want you to look at this clearly, then you show me exactly what you think. We have this low here. You can see that the stochastic hit below 20 here. At the same time, we had price reversing from this level here. So as the price now was coming down, you can see there's this slight move up, and then there's this move to the lower side. So we saw the same thing. The price moved up and then it came down. The stochastic moved up and then it came down. But notice something. The price actually went below this low, while the stochastic reversed before reaching this low, the previous low. So when this happens, when the price now begins to reverse and you see the stochastic reversing above the previous low, this is a negative divergence case. It's a very good sign that we are now upwards. You're supposed to look for a buy position. This is a very good case of a negative divergence. It means you're supposed to be looking for buy positions. Is that clear? So somebody may argue that this may not make much of sense. It may not make a lot of sense now, but if you learn to wait for such setups, it makes the most sense. So another thing, this is one. Let's get one more example. Let's get one more example for the same. Okay, look at this one. Look at this point. We have this horizontal line around 124.83, and then we have another horizontal line at this point. Then we draw a vertical line touching both the stochastic and price, this one and this one. So we highlight the point of intersection where these two meet, and also this one here. So look at it clearly. You can see that somehow the price is on the same page. When this was giving us a buy, this was giving us a buy. Then something now happens. The price continues up, comes down, up slightly, then breaks below. It actually goes several pips up to this point. If you check the indicator, we were actually doing the same thing but in an opposite manner, which means this is now upwards. So this was the correct place somebody could have safely taken a buy from. If you were looking at this chart, you could have successfully bought it when the price came to this point here. And you can see that that's what has happened. The price eventually came up, even if not with many pips, but you can see that there's this attempt to move to the upper side. So these are very good setups that if one can learn how to identify them on the intraday basis, then you'll be able to make good money just by following those simple setups. Another example is here. So this day, like for 2 consecutive days, we were able to make good money. You can see that here. I will draw it afresh. Look at this lowest close, and then also look at this. Also look at this, and then look at this point where the price was below. While the price was below, while the stochastic was below 20 here, the price was here, then it continued up, it came down and even broke below. While it was breaking below, the indicator did not do the same thing. Instead, it formed a higher low here. This means we are now upwards. Therefore, you are supposed to look for buy position. So you can see that for 2 days we've had just good trade. This is a good one. This is a good one. Then even the one which you've just looked at in the past, just in the recent past, in this webinar, you can see that this was still upwards. So look at the same thing. We have the same thing happening. Just a second. We have the same thing happening there. And let's see what we have. The idea is to ensure that you trade only when the price was showing you the same thing when you correlate with the indicator, and then all of a sudden one of them is showing you something opposite what the other one is showing you. That's the correct time to enter the trades. So one other thing, it looks like we're not able to find the correct one as fast as we want to. But believe me, they are there. There are several setups that show divergence. You don't only have to use this indicator. You can use other indicators. You have the RSI. Basically, you can use all the oscillators. You can use the stochastic. You can use the average directional, average true range. I don't recommend this. It's not an easy one. You can use force index. You can use, maybe we have RSI. Let's look at this, relative strength index. You can use this one also, but personally I prefer the use of stochastic for divergence and convergence. So the next thing you want to look at when we're doing intraday trading is you want to ensure that correlation is actually working for you. If you're that person who wants to make quick money during the day and then leave the whole thing by evening, see to it that you understand the concept of correlation. Understand what correlation actually stands for. Correlation, the simplest definition is when several pairs of different base signal or different quote currency suddenly shows the same thing, the same setup, or suddenly gives the same signal. So if you have, maybe look at these symbols, there are several here. We have this, 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 we have a low majority. Assuming all of a sudden you find that like 3 of those symbols are giving you the exact same symbol, the exact same signal, and then the remaining 3 are giving you the exact opposite signal, then that is most probably the correct time to look for a trade. It's the safest time that when you enter a trade at that given time, you are likely not going to lose everything. So if you pick it correctly, if you are able to track correlation properly, you'll be able to make good money rather than just trading one single pair. If somebody, assuming today you start trading EURJPY, you'll master it properly. You know everything to do with it, but you not know that this one has more money than it, or this one has less money than the others. So that's the advantage of understanding correlation. You'll be able to make more money by simple moves. So you diversify. If you were to enter maybe a volume of 10 on this one, you can spread that volume across 6 other pairs. That is one thing you have to understand. You can spread the volume across several other symbols. Instead of just relying on one symbol, you can spread the volume. And just put 0.01, 0.1, 0.1 on all the pairs. At least 50%, if you understood the correlation correctly, will go your way. If you understood correlation correctly, then that will go your way. So these are some of the simplest tips that I follow. Like, I understand that the spreads of this symbol is this. So if the spreads are past this, I'm not going to trade today. But if the spread rises to this amount before the order at this hour, I'm not doing anything. So you have to understand that, because each pair has their own spreads. This one has their own spread, different one, and all of them, if you're using an ECN account, they have different commissions. All of them, the commission is not always exactly the same. The spreads is not always exactly the same. So as much as you understand that the spreads need not to be high, understand that the spreads of various symbols are different. Sometimes the spreads here could be extremely high than normal, while this one is lower than normal. So the one where the spread is lower than normal, those are the ones you look for intraday trades from. And also merge it with the idea of correlation. Understand several other pairs, then ensure that they are showing you the exact same thing, so that you enter trade just at the correct time, not when things are not your way. Because the market moves it as a whole. When we are downwards, it tends to go downwards as a whole. When you're upwards, it tends to go upwards as a whole. So ensure that you are upwards when it's going up as a whole, you are downwards when it's going down as a whole. Is that clear? Yes, that should bring us to the end of today's session. We'll meet again next week at the same time. So thank you. See you.